Thank you for watching the CEO Barbecue. My name is Antonio, and today I'm going to Nevada together with Joe Ofsenik, the CEO of P2 Gold. Before we get into it, though, I would like to warn you that we have not received monetary compensation for the production of this video from the company that's being interviewed. Please understand that this channel is a business that sells content producing services to companies, which means you cannot rely on this video for research, and you should treat this as an advertisement instead. Research is conducted by reading the company's official filings, which you can find on setterplus.ca. Please only watch this if you know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business where failure is the norm. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, so before continuing on, please talk to an investment advisor with a good long-term track record because your capital is at risk, and I am neither a licensed financial advisor nor do I have a good long-term track record. If you're not 100% sure you understand 100% of the disclaimers I just showed you and told you about, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said therein. That all said, P2 is listed as PGLD on the TSX Ventures Exchange, where over the last 3 months, an average of about 115,000 shares have traded daily. The stock's 52-week high is 22.5 cents, and its 52-week low is 5 cents. With a market cap of 11.5 million Canadian dollars and 152 million shares outstanding, today this is a 7.5 cent stock with a 50 and a 200-day moving averages at respectively 7.6 and 7.2 cents. There were 7 million options at the end of December, ranging in price from 8 to 25 cents a share, and there was 58.3 million warrants at various prices, ranging between 7 and 40 cents per warrant in this case, as well as there are almost 20 million convertible debenture shares at 7 and 10 cents, and that'll become clear here in a minute. But combined, that brings the number of fully diluted shares to 233.5 million, meaning an increase of about 57% in shares outstanding can be expected if all dilutive securities get exercised, which would then result in about a 36% ownership dilution. Again, that is if, that's always a big if, but if all of those actually get exercised. Waterton is a large shareholder of these shares at nearly 16%, whereas management and board own nearly 23% of the company, leaving about 2/3 in the hands of other shareholders. So 61.5% to be specific. Moving on to the financial statement, I'm going to be going through the numbers as of December 31st. So that's the close of the fiscal 2024. And on the balance sheet at that time were a little over $500,000 in cash and cash equivalents, as well as some receivables. And on the liability side, there was about $2.7 million in current liabilities, most of which, call it $1.5 million in the form of that convertible debt. And the second largest chunk was almost $1 million in related party loans. The non-current liabilities contained a $153,000 obligation for the Gabbs project, which I'll tell you more about in a minute. But since this report, P2 has actually already made the final payment to Waterton in relation to this deal, as well as they've received almost $1 million Canadian dollars, as well as 1.5 million shares of Kingfisher Metals since this report was published. And that was with relation to the sale of the BAM project up in BC, which Dustin and I actually did an interview on earlier this year. And to my estimation, those shares are now worth about $500,000, but whether P2 still has them and what they plan on doing with them is hopefully something Joe can tell me more about in the latter part of the conversation. Moving on with the December financials, though, for the fiscal year that ended on December 31st, P2 recorded a total of $2.1 million in operating expenses, although that does include over $35,000 in depreciation and about $175,000 worth of share-based compensation. So call it $1.9 million is what the out-of-pocket cost was for the fiscal 2024, or an average of just over 157,000 Canadian dollars on a monthly basis. Now, about 23% of that money was spent on exploration and evaluation. That is, if you're looking at the financials on your screen now, you'll notice that's down about 90% year on year. And that's because the company was not actively drilling in 2024. Instead, they were running a PEA And again, that's something we'll talk about later on in the conversation. But that also places them at about $1.5 million for the entirety of 2024 in terms of administrative expenses. And that is an average of rounded down to $120,000 on a monthly basis. The largest chunk of that expense, the administrative expense, was about $640,000, which was spent on investor relations and shareholder information, which accounted for about 43% of the overall spend, whereas G&A came in second at 37%, with professional fees making up the remainder of the administrative expense. In terms of ratios, as I told you, about 23% of the operating expenses can be attributed to exploration, and so 77% is to be attributed to administration. And I would also normally provide the drilling to marketing ratio, but again, 2024 was all about the PEA. There wasn't much drilling to speak of, but that might be changing in 2025, again, which will be part of the conversation today. Also, there are interest and finance expenses as well as forex losses to speak of, and I would encourage you to review those for yourself in order to better understand everything, as well as the convertible loan. So please go through their financials yourself, as I'm obviously not infallible. I might be making mistakes in my reading and or interpretation of these numbers. Their financials can and should, of course, be found on setterplus.ca. Now, the PEA that I've referred to a couple of times in here was done on the Gabbs project, which again is a gold and copper project. It's actually a gold and copper and silver project, which is located in the Silver State, Nevada, along the Walker Lane trend. The base case of the PEA was done at $1,950 gold, $25 silver, and $450 copper, and it showed an after-tax NPV5 of $550 million, dropping to about $257 if the total cost of the capital is increased to 10%. So that's an NPV10 of 257. Now, the NPV5 is also generating a 21% after-tax IRR and a payback of the initial $365 million capex of 3 years, whereas the LOM was estimated at just over 14 years. So again, I've kind of ran through everything here, but there's loads to get into here today. But first of all, Joe, thank you so much for sitting down with me today.
Good to see you, Antonio.
The pleasure is all mine, of course, and it's good to see you as well. But since this is your first time on the CEO barbecue, we'll have to go through a couple of obligatory smell test questions, if you will, first, before we actually start grilling. Starting off with yourself, who are you and why do you think you're the right man for the job?
Okay, well, let's there's me, and then it's not just me at P2. We've got a team. Ken McNaughton, he runs our exploration development. He and I have worked together since 1996. We were integral parts of the Silver Standard team. We took that company. Ken was already at Silver Standard when I joined in 96, had about a 50 million market cap. And then when we left to start up Pretium Resources, we had taken that from 50 million to about a $2 billion market cap. We had the largest silver inventory in the ground. We had 2 billion ounces of silver, and we had just put a mine into production in northern Argentina, the Pirquitas mine. So we did a lot at Silver Standard, and now the company's still operating, and a large part based on what the funds we left in that company. It's now called SSR Mining. So we moved on while we were at Silver Standard. Ken was running an exploration program up in Northwest British Columbia on a project. We had discovered what became the Brucejack mine in 2009. In 2010, our board wanted to sell that project, so we had a company set up. We sold it off to this other company, and then we quit Silver Standard, went to this other company. It was Pretium Resources, and that's the Brucejack mine. So we took that from discovery in 2009. August of 2009 was our discovery hole. Great grade, 16,500 grams of gold per ton over about 1.5 meters. We took that hole. Based on that hole, we took the company, sold the project into Pretium Resources, and we took that project from discovery to first gold pour in under 8 years. And that's in northern British Columbia. So we're quite proud of that feat. So we know what needs to be done. We know what it takes to build a mine. We know what it takes to discover a mine and how to move it along. And we recognize what is a mine. At Silver Standard, a number of the projects we had in our portfolio either are currently mines or have already shut down, that they've been mined out. So we know what it takes to build a mine, to find a mine, and to move things on. So that's a bit about our team.
Have you worked with similar geologies before? I think you're going for a heap leach essentially here, though it's a little more complicated. We'll get to that before. But does the team have specific experience for the task at hand?
Heap leach and mill. We've built mills down in Argentina. That was a zinc tin mill, and a fairly decent sized production. So we built that. Bruce Jack was a predominantly gold, bit of silver mine. We did have projects we were bringing along. We didn't put them into production, but uh, in Nevada at the time, a couple of projects that are still around. We brought those, so we know the area. We know heap leaching. We ran a lot of pilot tests on a heap leach project up in the Yukon Territory, copper heap leach. So we know what it takes, and we also know who to deal with, and we know the right people to work with. So we have working for us in Nevada, KCA, Kappes Cassidy. It's when it comes to heap leaching in Nevada, you can't find a bigger name. They've been around since well, the 70s, I think. One of the pioneers of the heap leaches in Nevada. So we know what it takes to build a heap leach complemented by a mill.
The final product that would potentially come out of this operation here is a gold doré and a copper concentrate, as far as I understand it. Does that change things?
We produce gold doré at Bruce Jack, and we also produced a gold concentrate at Bruce Jack. So concentrate's concentrate. We know how to deal with it, who to talk to sell it and work on. Yeah, so there's couple stages. I don't know how much you want me to get into it right now, but at Gabbs, the plan is we do 5 years of heap leaching, and then after that 5 years, we do another, 9 years and a bit of heap leaching plus milling, where we produce a flotation concentrate and doré from the mill, and we produce copper SART concentrate and gold doré from the heap leach. So got a couple of avenues going there, but we know how to produce them all. And we know where to sell them.
Yeah. And we'll definitely talk about some of the specifics on the project, and that transition period is interesting to me as well. Going back to yourself and management ownership is noted at about a quarter of the company. We can call this 22.7% to be specific. How much of that is you personally?
I'm at my last shareholding was just under 15 million shares, and Ken's got about 18 million shares. Between the two of us, I think we're just under 10 million Canadian dollars invested in the company. So
Right.
we're almost the market. We have as much money invested in the company right now, pretty much as our market cap.
So that's actually money that you've put into the company, because that's typically my
That's
follow-up question. Is
hard
it
dollars.
right? Okay. So no founder shares to speak of, or well, not a lot,
No,
or how does that look like?
no. Our average cost, last I checked, we were about 40 cents, but I put some more money in that last financing at 5 cents, and I also bought some of the convertible debenture. So my average cost is probably in the 20 to 30 range. I haven't run it out. Yeah, I've lost track of that, but I'm in the 20 to 30 cent range probably on cost base.
I'm sure that's what you tell your wife. You've lost track of that. It's not that you don't want
Trust
to know.
me. Yes, that's why, yeah, trust me.
How big of a position is P2 in your portfolio? How important is this investment to you?
Well, this is everything I'm doing. I'm on some other boards,
Mhm.
and this and that, but our focus, both Ken and I, this is what we do day to day, and focus on. So it's important to us. We have some, you know, investments just to keep, as you say, keep my wife from having everything into P2. She believes in diversification, which is smart. But as far as investment in the gold space, everything I have is into P2 gold,
Mm.
and it's 100% of my real focus of time.
Right. That's actually another one of the questions that I wanted to ask, because I see that you're on the board of a couple of other companies. You became consultant to Tudor as well. I think you were even on the board of Victoria Gold too, right?
Correct. I was on the board of Victoria Gold
Yeah.
when they were placing the receivership, so I came off of that. I'm actually on the board of Tudor Gold,
Hmm.
so I'm as a director, so I'm not part of management, but I am a director on Tudor
Right.
Gold. And I'm also a director of a junior called CopperX
Copper
Resources.
X, that's right. But that's not taking any of your time. Like your focus is on
No,
P2.
it takes a bit of time, but that's a directorship. Like when it comes to managing and doing stuff, I'm focused 100% on that. Uh, Directorships, they don't take that. People always talk about directors, but most of them they show up, 4 days a year, 5 days a year, and they expect to be able to run the company. And no, it's the management that sees things day in, day out that really has to push a company forward. And so
Mhm.
that's what we do, and that's what we're focused on.
That's one of the reasons why I have the controversial opinion that directors should be paid in options instead of cash. Actually,
I agree.
well, that's maybe a podcast in and of itself, right there. Do you say that this is 100% of your focus? You've put a lot of money into this company, or at least what is to be a lot of money. Do you still have the ability to be on the bid and support the share price as you're going through this part of the Lassonde curve that you may call the boring phase of the Lassonde curve? Can you really be in the open market supporting the share price?
Well, we're that's why the share price is where it's at right now. We're not really supporting it. The one problem is, we're always like as we're moving things along, we're negotiating with this, we're negotiating on that, trying to move things forward. So it's hard to buy. You never really have a window to buy stock. Also, we've put up a lot of our cash already into the company, and so we're probably hitting the limits of our personal wealth that we can deploy for P2 Gold. But yeah, we think we're on the path now to get things going, and we have the cash that we need to take us to that next level.
Well, that's definitely going to be part of the conversation at the latter stage of the interview, because I am thinking, how do you fix it? How do you get out of this? And we'll get to that in a minute. But do you or any of the other board members or executives personally own a royalty on any of the projects?
No, no, those
No.
those are from the old days of guys working on the Vancouver Stock Exchange. No, nowadays, I'm not sure if anybody has that. But anyways, no royalties in any of the projects. Where
You'd
um,
be surprised. I have conversations with people who still actually do that, but I am happy to see your reaction is what it was. Are there is there a royalty on Gabbs here to begin with?
when we bought as background, we purchased this project off Waterton.
Mhm.
And part of the deal shares some cash, and we gave them a 2% royalty in the project. Now we negotiated when we made that part of the package. We negotiated the right to buy back 100% of that, so we can buy back the full 2% for 6.5 million US dollars. So our plan is we wait till we're in production, cash is flowing, and then we buy it back. There's no sense because that's an open-ended call for us. So
Mhm.
that's the way we structured it, and it's worked well. When we financed, we used private equity to fund the Bruce Jack mine because we had to raise money in 2015, which again was a pretty dark time for raising money for construction. And we negotiated a 5% stream on the project, but with the right to buy it back. Now, it was stiff. It was like a 15% premium on the money, but we bought it back, and that company got bought out for 2.8 billion US. So there's value there. It, you got to make some sacrifices to get into production and know what to give, know what to take. And so I think this six and a half million bucks for a 2% royalty buyback is pretty good value for us.
This is actually a good segue into the history of the asset. So we move on from the smell test into the actual barbecue. But what's the history of this of the asset of Gabbs? Who owned it before you? How did you get your hands on it? Tell me everything.
Well, the thing about Gabbs is there's a long history. It was explored, I think, first, well, let's go way back. There were small time miners in the late 1800s or the 1900s chasing sort of high grade shoots here and there. And so when we look around the property, you'll see old workings from that time. The property, not much happened there till about the 1970s. Company was started looking down there for copper, Cyprus, Kamenko, like These are well-known copper companies in the day. Then in the 80s, copper, and then looking at gold. In 89, there was a bulk sample taken there by Glamis Gold, which got turned into Goldcore, which is now part of Newmont. But the issue always with Gabbs and why we were able to purchase it now, and it didn't make it into production, is gold and copper. For heap leaching, and this is where the problem is, you use cyanide to extract the gold from the rocks. Well, copper, oxide copper is also soluble in cyanide. So what happens is you essentially a heap leach is a pile of rocks that's crushed up, and you put sprinklers on it and you spray water on it with cyanide content. It flows through the pile, extracts the gold, and you recover the gold from that fluid. Now, with gold and copper both get absorbed by the cyanide. The problem is gold, you could take the gold out, but the copper would stay in the solution, and you'd have to keep applying more and more cyanide. And so as a result, the cost just got higher and higher, and you can't make them. It's just uneconomic if there's too much copper in there. So what really carried the project? Like the project was permitted to go into production in 95 by a company that was the way they were going to deal with the copper was they were going to put all the rocks on a pile, spray it with acid, which would extract the copper, then rinse it with water, then spray it with the cyanide solution to extract the gold. Now, metal prices cratered in the 90s, middle 90s and that. And so they went into receivership. The project stood dormant. In the early 2000s, Newcrest out of Australia, came along. They did exploration looking for the bigger potential, which is still there at Gabbs, and we can talk about that at some point. But they came along. Unfortunately, they ran into problem. Well, fortunately for us, they ran into problems in Australia with some of their projects. So they just abandoned North America, walked away from the project. It essentially sat dormant. Guys were trying to do something, but it just sat there. And then Waterton, which is a private equity firm out of Toronto. I'm not sure if you're familiar with them. They made a name for themselves. A lot of people don't like them. Look, we've had great relationships with them, and it's worked well for us. But what they did when the market rolled over in 2012, and gold started going down, and nobody had any interest in it, they picked up a lot of projects in Nevada. And the way they did it is companies would need money, and so they would lend them money, and so it became loan to own, and that's what Waterton was known for. So got a bit of a bad rep because they would end up getting a hold of all these projects from companies by loaning the money and then taking back the project because they couldn't get paid back. So we purchased the project off Waterton, and that's a long-winded history of it. And so as you mentioned in your preliminary talk there, we have paid back Waterton outright, so they no longer have we don't have any further obligations to them for the purchase of the project. They do have a shareholding in the company, about 15% of the company, but no more obligations to them. And so that's our current status.
How's the relationship with Waterton right now? Because that is an interesting part to me. But yeah, how's that going?
They know. They're not here to build companies anymore. They're winding up their fund. The initial founder of the company is retiring. So we've negotiated, and we've got a good relationship with them. But they, at some point, are going to sell that. They know they can't sell that block of stock in the market because as soon as they start selling, they have to file insider reports, and everybody will say, well, why are we buying this? They're just going to sell all the stock. So they're waiting till we move forward, get a bit of momentum, and they're going to look for somebody interested in buying a block of our stock, whether there's a strategic partner or a fund that's interested in buying the stock. And so I think that's the way they view their exit strategy from the company.
Have they told you anything in terms of timeline? Because this is, well, it could kind of make it or break. Can they afford to hold it for a long period of time until you find someone to come in and buy these.
Oh, look at those. Yeah, that they're they've made a lot of money over the years. So yes, they can afford to hold it and
Okay.
hang.
That's always an important part for me when I see
Yes.
someone holding a large chunk. And you told me you're not going to be selling essentially into the market, and that's kind of to be expected. But also, you want to know what's happening with them. And the way I believe you're trying to solve the thing that people before you had struggled with at Gabbs with the copper is using SART or SART or SART, whatever you want to call it. We'll talk about
That's
that
right.
here in a minute, and how you see that working. But what is your, while we are on topic of your share registry, what's your share registry building strategy, if you want to use an expensive word for it? What's the profile of the people you'd want to attract as an investor now that the company is transitioning from exploration into the development stage?
Well, we have a good retail following, and what we don't have is that institutional following. And so what we need to do is take the company along. We have plans to bring it a little closer to um, feasibility, and at that point in time, I believe we'll be able to start getting more of a institutional following. For now, we are a retail shareholder base.
Right. But so when would be the right time to go out there and look for more institutions? And also, where do you actually go looking for them?
Well, I think this year is the year that we will. What we have, I think it's. I'm glad you brought that up because I got a little sidetracked with my background on the project. But I did say that the reason the project's available for us to buy was because of the gold and copper. And what happened between the company in the mid 90s that owned it and went bankrupt because of metal prices is that in the late 90s, SART, sulfidization, acidification, recycling, and thickening, that's SART, was developed. I can't remember the name of the lab that developed it off the top of my head, but a well-known metallurgical firm. So they developed this process that allows you to recover the copper out of the cyanide and recycle the cyanide, which then makes the project economic. So just wanted to bring that up as you'd mentioned the SART. So um, what we have going now, so this all comes back to SART, that's why I brought it in there, is we're doing a third phase of our metallurgy. It's just gotten underway now. We should have news out in a couple of days. We're just waiting to tweak a couple of things. And that phase of the metallurgy is focused on increasing the copper recovery. Right now, for our preliminary economic assessment that you mentioned, during the heap leaching portion of the project, we're using recoveries of 78% for gold, 54% for copper. We believe, based on the cyanide soluble copper from our test work and for gold, that we should be able to get the copper up at least into the mid to high 60s, potentially 70% recoveries. And we think we can get the gold up a few percent into the low 80s. Now, just by increasing recoveries, there's very little cost associated with that, just a little bit more cyanide. And so that essentially, those increases in recoveries all go straight to the bottom line and add value to the project. So the project we feel is already great. At current metal prices, we've got a 50% rate of return and I think an NPV5 of 1.4 bill over 1.4 billion. So, and the project is robust as is, but with this metallurgical work we're doing now, we expect to get results early in Q3, so say early to mid-July. That allows us to get that result out, which allows us to move forward with our plans to sell a royalty to fund the feasibility study on the project, which then allows us to start talking to institutional investors who want to come in because they can see that, okay, you guys are funded through feasibility, and that allows them to come in without fearing massive dilution.
It was SGS Lakefield with Kinross that
Correct. It was
developed SART.
Lakefield. Yeah,
And
Lakefield.
d- don't think I know that off the top of my head. I looked it up as you were speaking. But maybe you can actually, this is an important part of of the story here, in my opinion. But maybe you can explain to me why you think it's actually going to work. And maybe you can kind of walk me through a case study of someone currently using SART and the efficiency that they're getting.
Okay, let's look at right. just give you a few names of SART companies using them off the top of my head. Fortuna Silver, if you're familiar with Fortuna,
Sure.
they have the Lindero mine down in Argentina. It uses SART plant. Gold, if you're familiar with them, they have a SART plant at their Perel project. Torex Gold in Guerrero State in Mexico, they have a SART plant because they're started off mostly gold, and as they go deeper in their deposit, they're getting more copper, and so that's why they've put a SART plant in. Newmont down at Yanacocha, their big, massive mine in Peru, it has a SART plant. And I could give you more. I don't have them off the top of my head, but there's probably 10 to 20 that are operating at this point in time in the world. So they become quite common. There's a lot of companies know how to deal with them. And really what it is so you, like I say, it's a heap leach. So you're crushing up rock. In our case, we'd crush up rock to sub half an inch in size, put it on the pile, sprinkle it with our cyanide solution. When we collect the solution off the cyanide pile, we throw sulfur into the solution. So sulfidizing, that's part of the essence in SART. That sulfur mixes with the copper, creates a chalcocite, which is a sulfide of copper sulfide. We then add acid, which drops the pH down to about 3 to 4 from my memory. That allows the chalcocite drops out of solution. It precipitates below 5.5, pH of 5.5. The copper precipitates out, and the cyanide mixes with the hydrogen that's from the sulfuric acid that comes in and forms a hydrogen chlorate, which you then add, you then add lime. You're bringing the pH back up to 11, and that recycles the cyanide and allows the cyanide to go back into solution. So it's a real chemical equation. My days of organic chemistry and all that are like 45 years ago. So, that's not carried away, 40 years ago. I won't be doing the calculating and the formulating, but we know people that have the ability to do this and that. But that is essentially it. So you're taking the solution from the pile, you add sulfur, you form chalcocite, you drop the pH down, so it's quite acidic. The chalcocite precipitates out, you form a copper concentrate, a chalcocite, so a copper sulfide concentrate, and then you recycle the cyanide by adding lime. And then you just take that solution that from there, and after the lime's been added, you run it through a traditional gold recovery plant, whether Merrill-Crowe or ADR that you'll see. You extract the the gold, and then that solution just goes back onto the pile, and it's just a closed loop, topping up the cyanide as you consume it.
Yeah. It's I'm not a chemist myself, so you could have lied to me and I wouldn't have known. I hope you didn't, though.
But somebody watching would know, and they'd
Someone
say, "What
watching,
are you talking about?"
they've got my back. They would have me in the comments. But what if this doesn't work though, Joe? I mean, I know it's not, you don't want to think about it. There's places in the world where it works and so on and so forth. But what does the future of this project look like if copper recoveries remain where they are right now? Can you actually do what was not done before you?
Yeah, what we would do is build a mill. There's sulfide mineralization. We can also tank leach the rather than heap leach, but tank leach the oxide mineralization to recover the gold and the copper. Again, the SART's been proven. We've done test work already on the SART, and we have had, that's where we got our recoveries from. So we know it does work. But look at current metal prices, just throwing things out there. The project pays initial capital for the heap leach in the first year and a bit. Our plan right now is to put the mill in year 5. So by the time the mill is built, we have generated enough cash to pay for all that. So we're cash, cash flow positive after about year 4, even with building a mill. So this project is robust. Look, there's always things that go sideways on you, and it's how you deal with those things that comes from experience or the ability of your management team to deal with issues like that. But like I like to say, I don't know, shit happens, and it's mining, and it always happens. It's hard to avoid, and you have to be able to deal with that, have that flexibility, and able to go with the flow to make things work. And our team does. So we're comfortable that we can make Gabbs work.
And I assume this year you're also going to be doing some more met work. I would actually assume it would be kind of the star of the show this year. Is that going to be the main objective this year, met work?
Yeah, look, we should get the results of that met work out. I'd like to say, because we're a junior company, that we don't have the most stroke with Kappes-Cassidy, but they our work is underway now. It took them a little while to get in the queue for them to do our metallurgical test work. But we should have, because we're underway now, columns are 90 days for the most part. So, like I say, we need to wait for a report from them, but I would like to say early to mid-July, we should have the results out. We'll be, getting that word out on that, which lines up well with the Beaver Creek conference, that put the Precious Metal Beaver Creek conference in the fall, in September, early September. And that's where we would make a push to bring in more institutional investors.
And that's the met work that you're talking about here. That's specifically on the oxide portion of the deposit, right?
Yes.
Yeah. Okay. So when are you going to do some work on the sulphide portion?
We've done some work We've already done work on the sulphide. Numbers are solid. I think gold's 95% recovery. Copper, off the top of my head, is 81% recovery. And the good thing about using Kappes-Cassidy is they worked on this project for other companies in the past. We have all their data, and a lot of flotation test work was done for the sulphide mineralization. So we have access to all that all that data. We've done some follow-up tests just to confirm that it's accurate. But Kappes-Cassidy has done it all, or has the access to the data from the firms that did it. So we're very comfortable on the sulphides. We're very comfortable on the leach kinetics for the cyanide with the gold. And so really the only new technology thrown at the project is that SART technology. And that's what this round of metallurgy is focused on, is improving the recoveries with the SART technology.
So from the perspective of deleterious elements, because that's where I was going with this, arsenic, mercury, selenium, anything?
Nah, we're pretty good. There's a bit of arsenic, but not much. It's quite low. I think we're a little bit high in tellurium, which nowadays is a critical mineral. One of the metals that China cut off to the United States is, they cut off I think about a half dozen critical minerals. One of them is tellurium, and we have that in our deposit. And so we're going to see, it'll come out of this round of metallurgy. That's sort of like it's not a focus of the metallurgy, but we will come out of it with to see what the recovery is on the tellurium and whether we can make that a paying element for us.
Well, because with heap leaches, that's obviously one of the important parts. But then there's also the carbonate content in the host rock that I've written down to ask you about. How high is that? As in, is there something to challenge your acid consumption?
No, we're not in carbonate rock, so the deposit's not hosted in that. So it's monzonite, where the majority of the mineralization is, the higher grade. So yeah, we're good on that front. We're not going to consume a lot of acid dealing with carbonates.
Okay. To go back to the sulfides though, you're going to be doing gravity flotation for the sulfide phase. Have you done, or are you going to be doing
just flotation?
Okay.
We historically, we'll probably do a little gravity ourselves as we get closer to getting the mill going, just to tweak the circuit. But based on all the historical work, there was a lot of historical work trying to get the gravity to work. And we use gravity up at Bruce Jack, the target was 40% gold recovery from gravity, and we ended up at 60%. So, gravity's great if you can get it to work, but historically they have not been able to get it to work at Gabbs. So, down the road, we'll put a little time into that, but right now it's flotation.
Mhm.
So you produce a float concentrate, and then you take the tails from the float concentrate and you leach that to increase your gold recovery. And so that's what we plan to do.
What about refractory tendencies in that case in a
Yeah,
sulfide ore?
good recoveries.
Yeah.
Um, Silver is probably the lowest on the recoveries, like from the flotation test work, and that, as I say, mid 90s for gold, low 80s for copper. Silver is down, I think. Uh, you know, Silver is a minor payable for us. I can't remember it too well, but I think silver recoveries in the sulphide are probably only around 55 to 60%. That's going from memory, so don't hold me to those numbers.
Mm.
But the gold and the copper liberate nicely, but the silver is tied up a bit.
Well, what about the copper concentrate? In that case, is it clean, or you're going to have to do some
Yeah,
blending?
it's a clean concentrate.
Okay.
Mid to high 20% recoveries of copper is what we've seen in the concentrate, which is a marketable concentrate, pretty good. So we're happy with that. Now
Yeah.
that's the flotation copper concentrate.
Mhm.
The SART copper concentrate is, from the work we've done to date, it's coming out 50 to 55% copper, and we'll see what it comes out of this round. We're going to actually, one of the things coming out of this round of metallurgical testing is producing SART concentrate that we can go out to the market with,
Mhm.
and start marketing it to buyers.
Go out to market with would mean what, 25% in your case.
No, not the flotation concentrate. At this point, we would just go to market with to market the SART concentrate,
Okay.
which is going to be 50% plus
Yeah.
copper.
Yeah,
Um,
that's for sure viable. But what about again, and kind of trying to balance both situations? If it's not SART, but it's flotation, is that still viable? Well, in your case, is it
oh yeah,
SART?
yeah, no, that's entirely marketable. Yeah,
Mm. Okay.
you want to be north of 20%. Otherwise, your trade-off is it's like everything. It's when it comes to concentrate, a big item is, ignoring whether there's bad elements in it or anything like that. Concentrate, if it's 26% copper, that means 74% of it is not copper, which is, but you have to truck or train all that to a smelter. So it's your transportation costs. So the higher the copper concentrate, the better payable against transportation costs, and that's the trade-off. But at 26%, that's yeah, it's quite viable, good economic copper concentrate.
I was actually under the impression that it's north of 24, essentially saying that the cutoff is kind of 25%. But you mentioned 26, so that's what I was
Yeah,
getting to.
yeah, it just depends, and a lot of it's so much is tied to the copper price, right?
Yeah, yeah,
Versus your transportation costs, right? And so if copper is like right now, copper's moved up a fair bit, oil's staying relatively flat in that mid to low 70s. So you're going to see the cutoff on the copper con dropping down because you're getting more value for the copper than and the cost to transport it's not moving.
Mhm. This is Nevada, so I don't suppose topography will work against you when it comes down to the heap leach pads. But again, you have recent native experience, I suppose, with Victoria Gold from
Oh,
that. Um,
absolutely. Yeah.
I mean, I guess what have you learned from that experience with Victoria Gold, and is there something that you can adjust or use?
Com- com- Complete, as you mentioned right at the outset, it's a topography.
Yeah.
We have, if you go to our website, there's some photos, or open up our latest presentation, you'll see photos, and the ground gently slopes to the north. And so, which is nice. It's a nice, gentle slope. So you can stack your material. You don't need a dam or anything else or a berm. It's almost flat ground. There's just enough slope so that when you're sprinkling your fluid on the heap, your solution, that it collects and drains down to the north. But you're not, it's not, you're not building on the side of a hill like Silver Standard or SSR Mining had their issue in Turkey. Victoria Gold had their issue in the Yukon. You don't have that steep a slope where you have to worry about containment.
Mhm. Have you had that geotechnically confirmed?
Oh yeah, well, you just have to look at it. But yeah, we've got geotechnical work. We have to do some more geotechnical drilling to confirm our pad locations and that. But historically, some work was done already. We just need to do our own to make sure true it up. Right?
Okay. Is there something that can challenge stability in Nevada, specifically from the geotechnically, specifically like clay or something else that's typical to Nevada?
Now look at, there's been a lot of work done where we are, where we don't envision any issue with clays or anything else. The bigger issue for us is going to be, finding some clay to put the liner down under our heap leach.
Mhm.
So we're gonna have to truck that in, and that's one of the costs that we have in our capex. Um, but no, we're not really in an area with clays. Look at when the reason we bought this project is we looked at all the historical data on it, and there's a lot. Uh, we had just come out of building the Bruce Jack mine and that, and at Bruce Jack, you're at whatever we were at, roughly 1360 meters, 1370 meters. We had to build a 75-kilometer road. 12 kilometers of that went over a glacier. We had to build a 57-kilometer transmission line. Two of the spans of that transmission line, when we're going up over the glacier, one was 2.2 kilometers, one was 2.1. I think they're the longest spans in Canada for a transmission line. So there was a lot of technical challenge in just building the infrastructure for Bruce Jack. So we come down to Gabbs, we've got pavement when we drive right onto the project with pavement, roads all over the project. We've got a pretty good sized power line coming right up almost to the border of our property. And so all that infrastructure, we looked at that, and then we looked at the deposit. Now, the grade is not a barn burner. Bruce Jack had a high grade. On the other hand, that grade had to pay for a lot of costs to build this infrastructure. At Gabbs, we don't have the grade as much, but the metallurgy is good. The only issue with metallurgy was the gold and copper. There was nothing was locked up. We didn't have too much fines, too much clays, or anything else that would clutter up a heap leach. So all that was clean. It was just, gold and copper was the problem. So we took the project on because we thought, look at, they've developed SART plant since then. We've got the ability to use a SART plant. We've got great infrastructure. We can make this work. And so yeah, so that's how we looked at it. So from a technical perspective, project's got everything going for it, other than you need to deal with the gold and copper. That is truly the reason Gabbs isn't just a hole in the ground today. Otherwise, if it wasn't for that, it would be mined out and we'd be looking at a hole.
Well, actually, I do want to talk about whether it would have been mined out, because maybe there's more there. And that's, I think, something you're going to go after as well. Just one more point on the geotechnical drilling here. What's kind of the unanswered question that you're going to be answering with that? Is it the strip ratio optimization? Because I think you're working with a 45-degree
Correct.
pit wall. And then you're probably drilling the contact between sulphide and oxides to better understand that, know how you're going to transition. Those two is what I'm assuming, but what else?
Okay, so yeah, we believe we can steepen up those pit walls, which again drops your strip and increases your profitability by doing some geotech drilling. The other thing, we just need to do some geotech drilling where the pad's going in to make sure we don't have subsidence. And that's, a couple of holes where the heap leach pad's going. Otherwise, you've hit the nail on the head with what we're doing.
Right. Again, better understanding that contact between sulfide and oxides. I think I'm very focused on that part specifically. Maybe you can talk to me more about how you're going to transition from the oxide to the sulfides without there being kind of a jerk in operations, if you will.
Well, right now, the way we have it, we're in the oxide for the first 5 years. We're stockpiling a bit of sulphide. So 9 million tons a year for the first 5 years, oxide heap leach. Any sulphide we are mining, uh, we stockpile that. There's not that much, maybe 1 million tons off them from memory, 1.5 million. And then when the mill starts up, we switch to 4 million tons of oxide per year, 5 million tons of sulphide through the mill. That transition between oxide sulfides is quite defined there's not even in the sulfides, there's not a lot of sulfides, but you go from almost no sulfur when we do multi-element analysis of our assays when we're drilling, and you go from almost no sulfur, and then also you hit that transition, all of a sudden it pops up, and within a couple meters you go from oxide to sulfide.
Right.
It's a pretty stark contrast.
Okay. Groundwater is also something that you say you're going to drill a water well, but that could also, I guess, be a double-edged sword. I mean, water in the pit walls, you don't want that. It could result in
Yeah,
slope creep.
correct. Yeah, you have to pump. But from historically, where the water is out a little more on the pediment. There was a water well permitted and drilled in, I think, 89, 90. So we've got all the original permit filings and all that. We expect to have our permit for the water, let's just say, probably not, people tell me April, May, so let's say May. So we'll get our permit for the water in May, and then once we have that permit, then we're allowed to drill a well, and for the amount of water we've permitted. And we've permitted enough water, I can't remember the number off the top of my head, that would allow us to take care of the heap leach and the mill.
Okay, so that's basically your end all be all water permit. You don't need any more
Correct.
water permitting right after this.
Correct.
Okay. What about other permits? What else do you have to get in terms of approval in order to do that work that we've just talked about this year?
Oh, nothing. We're good. We're good for that. We get our water permit. We can drill the water well. One thing, we have 2 notices of intent to work on the property. The reason we have 2 is because it's it's a big property. Roughly, what are we at? 48 change square kilometers. But we have we have different zones of mineralization. So as long as we keep the permits, the permitted areas a mile apart, we can have 2 permits. So we have 2 permits. One covers our Lucky Strike zone, and one covers our Sullivan and our Carbonate zones. So we have room under those permits to do some more exploration drilling. We know where there's some high-grade mineralization that we'd like to drill and bring in at Sullivan. We never got a chance to in the past. If the opportunity to raise, we need roughly about $1 million US. We can go in, because these aren't deep holes, a couple 100 to 200 meters. We can drill some nice grade near surface mineralization at Sullivan. And then also, like right now, our resource, just as background, I should have mentioned this earlier, we're just under 3.5 million ounces of gold equivalent. And that's roughly 2 million ounces of gold and another roughly 1.5 million ounces of copper for gold equivalent. We feel near surface, there are 4 known zones of mineralization. We feel with just those 4 known zones of mineralization, we can push it out to 4 or 5 million ounces. Now, those zones all outcrop at surface, and so that's why they've been worked on. No one has really looked for targets that maybe didn't make it to surface. And so the southwest corner of our property there, I was just out there, was it last month? Yeah. No, sorry, February. And we're in April now. So I was out there in early February, and there are just a lot of workings where guys were chasing gold and high-grade copper in small underground workings in the southwest corner of our property. No one's really drilled there. We haven't drilled there. We're going to send our head geos to be down there for, this month. He's going to spend the month down there, really focused on drill targets. What we'd like to do, we'll get our metallurgy out, see how the market is. If the markets, without a lot of dilution, we're able to raise some cash to do that drilling. We would go in there and look to drill the known, expand the known mineralization somewhat, but also put some holes into this area because we feel there's a lot of mineralization potential near surface at the project. So, right now we're waving 4 to 5 million ounces, could be even more near surface. And then that's not talking about the mineralization at depth. We believe there's a porphyry sitting at depth underneath the property that's driving this mineralization. But, that's from our geophysics, we think that's down about 400 to 500 meters. And so that's more expensive drilling, better to focus on getting in production, generating cash than looking for more ounces down the road.
You say these zones are outcropping and they're partially drilled. Why haven't they already been added to the resource? Or
Well, the ones that are Lucky Strike needs some more drilling. We can expand it, but it's in the resource. Sullivan Carbonate are in the resource. Gold Ledge, unfortunately, Gold Ledge sits midway between Sullivan and Lucky Strike. So when I said we had two permits and you have to keep them a mile apart, Gold Ledge is right in the middle of that mile apart. So we can't get in there to drill that until we get a plan of operation. So, okay. But these zones have been drilled. We can drill more. They're all open. What we did is we got to 3.5 million ounces, and look at a lot of guys will just keep drilling and drilling and drilling and make bigger and bigger. But our view is you're not there to drill, you're there to build a mine. And so we did our PEA to prove up that, okay, is this economic? Can we build a mine based on the grade we have with the infrastructure we have? And based on our PEA, yes, it's going to be quite a good mine. But, we just didn't want to go drilling, and then find out after drilling, how many millions of dollars that, hey, this thing's not going to make it as a mine. So that's why we took this approach. Make sure that the mine, that your project can be a mine before keep on drilling too much.
Yeah. You said you've got about $1 million right now. Is that correct?
Yeah, just over that. Yeah, roughly in that ballpark range. Yeah.
And that's going to cover G&A, geotechnical drilling, the water well, the step outs, or like how do you see that?
No, what it'll cover, it covers all our metallurgical work. It will cover what I would like to do once we get the metallurgy out, assuming it's comes out as we expect it with a nice bump in the copper recovery, a little bit in the gold. We'd like to update the PA to bring those economics in. Covers that, covers all our property payments, G&A right through to next year. Water well, we'd like to drill that water well. We're just trying to decide, when's the best time to drill it. We would have, you spoke about this earlier. We've got some shares from Kingfisher as well as the cash. So those shares are roughly worth about $500,000 right now. So we're going to eventually we like Kingfisher and we think they're sitting on something that's going to great potential, but we're focused on Gabbs. So we'll see how their drilling goes this summer. If they have some success with their drilling and their share price moves up, maybe we'll take some of that off the table and use some of that to fund the water well. So we're evaluating things right now. To do the actual exploration drill program to expand the resource with that target of 4 to 5 million ounces, that's going to require us to raise about $1 million US. So, we'll watch the market for that and see whether, because one issue, as you talked about early on, our stock's at 7.5 cents, and we don't want to really dilute too much. So, it's a trade-off, right? You got to move the company forward. On the other hand, you don't want to dilute all your existing shareholders and blow them out, especially since we have a big position. We're shareholders and we have a vested interest in making sure that we don't, really blow up our capital structure. So there's a trade-off there. So like I say, I think you get the metallurgy done. We sell the royalty. That allows us to bring in more institutional shareholders. We expect our shares to re-rate once we can get that royalty sold, because people realize, okay, they're not going to be selling a lot of stock to fund a feasibility study. They are funded through feasibility study. We feel our feasibility study cost is about 10 million, and we should be able to get that from the sale of a royalty or more.
But it's challenging from the perspective of, first of all, as you mentioned, you have to do work, right? You cannot just stand still. You're a public company. That's
Right.
what shareholders want you to see doing. But you don't want to dilute too much, not at 5, 6,
Right.
7 cents, whatever it might be. So that's a conundrum in and of itself. But then also, what is the work that the market is actually going to care about? I mean, we talked about geotechnical drilling and metallurgy, and these things are interesting, especially to a potential buyer, which is something I hope we can talk about as well. But how do you get the market to care about you in what is, in this stage of the Lassonde curve, specifically because, again, you're now a one asset company. You're entering that boring engineering phase where sometimes even new discoveries and expansion of the project can still fall on deaf ears. So what's the plan for dealing with that? Is it a new project, different marketing,
Look at
something else?
that is a good question. And we think about this, and if you look at things, you got to dilute somewhere. You're either to move ahead, you're either diluting on the equity basis, or you're diluting your project interest. And we feel right now that the better value is in for shareholders is to dilute at the project interest by selling a royalty. Now, the feedback we had from talking to the royalty companies before, they'd like to see another round of metallurgy. We're going to have that in not too long, 3 to 4 months. And then it's they want to see people closer to production, but eventually you run out of people that are really close to production, and they have to start giving royalties. Like, if you go back, I don't know, 7, 8 years, they were giving royalties out for pure exploration properties. So it goes in cycles. And so we feel we're in a spot where we will be able to sell a royalty to fund our feasibility study. Now, that in itself should help with our share price, just because people know, hey, these guys are funded through feasibility. And so the next thing after that is development. So that takes us a long way along that Lassonde curve. The other thing, I think that the reason we want to get back to drilling is the market always appreciates drilling and good results to show you have some size. And I think one of the things that's impacting us is we maybe we made a mistake here by doing our PEA too soon, but I don't think so. But people like that 5 million ounce threshold. When I was younger, this goes back a bit, the majors used to say, we don't look at anything under 5 million ounces. Well, they've gone to bigger things. And the mid tiers now say, well, we want to see 5 million ounces. And so I think if we can show, we talk about it and we can arm wave, but until you drill and show that you can get to 5 million ounces, people don't really believe you. So I think if we can drill, get that drilling done, show a path to 5 million ounces, all of a sudden people say, okay, they've got a 5 million ounce plus deposit that's, in Nevada, great jurisdiction, not far from getting into production. We think we could be in production in 4 years. Those things all start clicking along, and that's what's going to re-rate our stock and get it moving up along the curve.
Are you thinking of redoing the PEA for, again, potentially this, what you're hoping for? So it is forward looking, but if you're able to get to that 5 million ounces, redoing the PEA or just jumping to PFS?
I think, look, it depends what we hit. If we hit into something that is significantly different, we redo the PEA. But I think what we would do is just update the PEA on the resource and with the resource and the metallurgy. Now, if we get closer to 5 million ounces and it's more of the same rock and that, which we would expect it to be, okay, well, what are you doing then? You're updating the PEA with the metallurgy, and maybe you're expanding the production from, as I say, right now we're 9 million tons a year for 14 years, 14.2 years. Maybe you up it to 11 million tons for 14.2 years, or do you extend the mine life? You just keep it at 9 million tons and all of a sudden it's a 20-year mine. You have to make those trade-offs. And so we would look at that. But, let's not get the cart before the horse. For now, we've got 3.5 million ounces. It's economic. Let's just push it ahead on that basis and just show the potential to make it bigger.
That also means no JV partner before actually having to, having to build it essentially.
Yeah, look, I don't think, from my experience, look at our production profile. uh, Currently, if you look at the 14-year mine life, on average, we're producing 104,000 ounces of gold a year. It varies. The peak year, I think, is under 50,000 ounces, but 104,000 ounces of gold a year on average, 13,500 tons of copper metal a year. Um, that's a nice mid-sized mine. On equivalency basis, depends on your gold copper ratio. It's between, say, 150,000 ounces of equivalent up to almost 200,000 ounces of equivalent. So that's a nice mine, but that's not a big mine. So as a JV, I really don't think at that size mine you want to JV it. We don't, there's the risk is known. We know we can raise that. We've raised more capital for other projects in the past. So we can raise the money that we need for this. So yeah, I would not be looking for a JV partner to build this mine. I don't think that's needed. And I think, to be honest with you, the project's just not big enough. Otherwise you have two people with a 50% interest in a 150 to 200,000 ounce mine. And, doesn't give you a lot of leverage.
Hmm. Well, that is ambitious, and it's interesting that you take this approach where you don't want to, well, you don't want to dilute too much, essentially at all cost. What is the? Let's maybe recap. I think you've mentioned it already, but maybe we can recap on how much money do you have to spend before being able to sell the royalty, and essentially what I'm asking is how much more dilution before being able to say no more dilution ever, essentially.
I believe that we should be able to sell the royalty with the funds we have
Hmm.
and potentially the Kingfisher stock. But even without that, uh, I believe that this round of metallurgy that's going on now should put us in a position to be able to sell a royalty.
Hmm.
And so that's why we're focused on moving that forward. Because if we can get that royalty sold, then we're not diluting anymore if we can get 10 million plus for that royalty, that takes us through feasibility. Now, where the dilution would come in is to drill to expand the resource, because we would want to keep the royalty money for the feasibility
Mhm.
study.
Right. So, well,
And
but
so,
that still puts you at what? Just one more capital raise, grow the resource, do a PFS, and then you're starting to
yeah,
think
no,
about
we wouldn't do
FID.
a PFS. Just to jump in here, we would go straight from PEA to feasibility.
Oh,
Uh,
okay.
we There's been a lot of historical work done on this project in the 80s and 90s. As I say, the only real work that's new is the SART work, and so we would do some more SART work within feasibility,
Mhm.
but there's no need to do a pre-feas in our opinion.
Right, 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 right. So it's the FS, PA to FS. Interesting. How's the community relationships? Is there a community or someone that you have to get approval from?
Uh, no, it's always good to be on good terms with your community, but we're on BLM land. We have one patent, but predominantly BLM land. There's a town, a small town, from what I understand, about 475, 450, 475 people, called Gabbs. It's the namesake of our project. I guess we were named after it. It's 6 miles down the road, so 10 kilometers down the road. It's a mining town. We're on the south side of that town. Just on the north side, pretty much just outside town limits, is a magnesium mine that's been, I think it's the longest continuously operating mine in Nevada. So I think that's on their website. So it's a mining town. So people are looking more for work than for opposing mining.
Hmm. Right. All right. What else we have left? G&A, I know you touched upon it there. I said about 120,000 is what you spent last year on G&A. That does not include share-based compensation. Is that where you're targeting this year, about 1.5 million for the full year?
Well, look, it depends how you look at it. What we have, just if you look at hard dollars for that we're putting out. We put out about $20,000 a month to keep everything going. Hard dollars. We're not taking senior management is not taking salaries. So we're accruing, and then we'll deal with those either with shares for debt or something down the road. We'll see how we deal with them. But like just looking at cash burn versus G&A, about 20,000 a month, and then there's property payments and other. So probably hard dollars, you're looking maybe $500,000 a year, hard dollars all in to keep the company going.
Right. How much of that do you think is going to be in marketing? What are you budgeting for marketing?
Well, that's what we're looking at. Right now, we're not budgeting much for marketing, very, very little, because we feel there's no sense marketing when you have nothing to talk about, because people want to hear you doing something, not just, yeah, this is great. So we're talking about it right now, our marketing budget and what we should bring in and the timing of that. I think we need to do some marketing, get the marketing ramped up before we get the results of our metallurgy out. So start marketing into that so we can start talking about getting out and showing the benefits, what we're doing, how we're going to finance and things like that. So right now we're working on the budget and we haven't set it yet.
But that's going to be included in the 500 grand, essentially out of pocket.
That would be on top of the 500 grand.
On top of it? Okay. What's going on with the convertible debt? Again, I noted it at the beginning on your balance sheet. What's the state of that?
Okay, so it was 1,665 when we 1,665,000 Canadian when we launched it. We have exercises, I think right now, off the top of my head, we're about 1.3 million remains outstanding. The conversion price has gone from, at January 31, the conversion price went from 7 cents to 10 cents. So dilution's now about 13 million shares if it's exercised.
That's if it's exercised. Do you have any idea of whether that's actually going to happen?
Well, it depends where our share price is. We have the ability to extend it it's due January 31 of 2026. So less than a year from now, about 9 months, whatever. Yeah, roughly just over 9 months. We have the ability to extend it for another year by paying 6 months interest. And so at the time, we'll see where we are with our royalty sale, cash on hand, and whether we pay it out with cash or do we extend it for a year, or is it converted? It just, I think if we get the royalty sold, you will see the share price well in excess of 10 cents. And there's some other things we're trying to do that I think will also move the share price up well in excess of 10 cents. So you may see the full converted.
What's the interest on it?
7.5%.
So, okay. So it's not SOFR, whatever, it's just flat 7.5%.
Correct.
Okay. Good. I have that on here. Joe, what keeps you up at night? I mean, you're here, you're presenting a bullish story, but nothing's ever really perfect. So if you had a magic wand, you could wave it and make something go away, what would you wave it at?
I would wave it at the share price. We need to get our share price up. That's, to start getting, we're very happy with the project, but our share price is what's holding us back. So we need to work on that. And so that's what we're focused on now. And the way to do that is to have news, to be able to talk about, show people you're moving forward. It's a little two-edged sword. You got to be able to have some money to do that. But we have the cash right now. We feel comfortable that we've got cash to move things along and get this metallurgy done, get the royalty sold, and take the company to the next stage.
What would you do differently if you could go back? Let's call it. Let me look at the chart again. Let's call it 2 years.
Absolutely, pretty easy on that. When we started the company up, we thought we were into a very good bull market and a bull market for juniors. So we had we had exploration properties, and we were looking for a more advanced property. And it took us a while to buy Gabbs because the more advanced properties were quite expensive when we started the company up in 2020. In 2021,
all of a sudden people are saying, oh, gold's coming off. And so, but we thought it's just a pause. So, prices got realistic. We bought Gabbs. But they continue to go off for grassroots company. But anyways, so we had a project, our BAM project, which we thought, and this is the project, part of the project we sold off to Kingfisher and got a project. We think there's a big porphyry project on that. So we spent money exploring up there. We tapped into some good gold on the neighboring part of the ground that we dropped because it looks like where the porphyry is on the ground that we sold to Kingfisher. And so, but the way we financed that, because it wasn't a market for the big exploration market, was through flow-through shares. And if you're familiar with flow-through shares in Canada, it allows you to pass the cost off to shareholders so that they can write the costs off on their taxes. The problem with flow-through shares is we raise it through flow-through funds. They're not really focused on the company as investors in the company. They're focused on getting a tax deduction. So you sell them the stock, there's a 4-month hold period. The 4-month hold period expires. Unless you come up with a big discovery, all those shares, you're eating those shares no matter what. They're selling them because they've got their tax loss and the stock's free trading. Now, if you got a big discovery, you've got enough buying that absorbs the selling from the flow-through shares. If you don't have a big discovery, which we didn't have because our work suggests it's to the north, but we didn't actually hit it, you just get a lot of selling and not a lot of buying. And that's what drove our share price down here. One of the big things. So flow-through shares, the debt to Waterton. Well, can't do much about the debt to Waterton because we wanted Gabbs and we bought it, and that's cleaned up now. But we did a lot of flow-through share sales, and all those shares are what drove the share price down. So now that sort of took the momentum out of the stock. We were doing quite well for a while, and so now it's regenerating that momentum. And that's, when you lose momentum, it's tough. And so we need to work on getting the momentum back.
Well, there's also a deal that you were working on in 2024 with Eskay that kind of fell through. What exactly happened there? What did you learn from that? And what are the takeaways?
Well, yeah, that deal. So just a little background on the deal. Eskay Mining has a nice piece of ground in the Golden Triangle just to the west of where our Bruce Jack mine was. So we knew the ground well. There are a couple of older guys that run the company. They're looking for some other guys to come in and help with management. We know the ground well. We had actually helped them out with some of their work when they had some difficulties up there. So so we thought, okay, if we put the two companies together, they've got an $80 million market cap. At the time, we had just under a $20 million market cap. We put the two companies together, we're roughly 100 million in market cap. That gives us some size and some leverage. We know the Golden Triangle well. We like their property. We think there's a big potential for a discovery on it. So that all worked well. Now, it wasn't, it was dilutive, very dilutive for our shareholders, but we thought overall, if we come up with a big discovery on their property, it'll work. And so we put the companies together on the basis, we talked about putting the companies together on the basis that, look, our management team has the expertise to make things happen. They had access to capital. And so they claim that, let's sign this up. We'll raise money and you guys will be able to go and explore this summer. And you'll also have some money to do some more work down at Gabbs. So it was a good fit. We can work at Gabbs and look for a big discovery on their ground in the summer. Once we signed the letter of intent and moved on, they looked at the market and said, well, we don't want to raise money at these prices. We're going to wait. Well, there was no sense in putting two companies together that were undercapitalized, because what are you going to end up with? Both companies down, a combined company that's going to be at a 10-cent level. So yeah, so we pulled the plug on that. If they weren't going to raise money, it didn't make sense for us. That was the only reason to do the deal would be the access to capital to get us through that phase, because we were at the bottom of the Lausanne curve and the market was in really bad shape. If June of 24, I'd say, was the low point for the junior market. In September, it started to turn, and it's still not great, but it's slowly moving, getting better.
Well, that's exactly what I was going to say, is that the market is still bad, still not great, that's for sure. And then you're still
Yeah.
at the same stage of the Lassonde curve. So is it, would you still want to work toward that kind of a deal, getting a new project, maybe in Canada, where you can do flow through and not having to, or something like that? Is that something you're thinking about, or is it just Gabbs right now, nothing else?
I think from our perspective, unless we saw a really, really good value to the shareholders of P2, focus on Gabbs, because we know it's going to be a mine, and we just have to tough it out and move it ahead, minimize dilution, get that royalty sold so that we can then take it to the next step.
Mm. We've been at it for almost an hour and 15, 20 minutes, something among those
Jeez.
lines here. So, Joe, this has
Yeah.
been it's been a long conversation. Let's pick it up maybe sometime this summer again. It's been a pleasure. What am I forgetting to ask you? What did you come here hoping to talk about that I failed to bring up?
No, look, I think you really you literally barbecue. You got right to the heart of the matter. So no, I think that was really good. Uh, I probably didn't answer things as best as I could have, but look at you hit the big questions, and really from our perspective, it's how do we get further along the Lassonde curve? And our view is we get the royalty sold, and the way to generate some interest in the stock is, maybe we need to do some more drilling and get over 5 million ounces. We know we can get over 5 million. Now we just have to show everybody else we can get over 5 million.
Got it. Well, hopefully we can talk about about all that later this summer, but I really appreciate your time for now. Thank you so much for sitting down with me.
Yeah, really appreciate it. Thank you.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know, and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias, and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company-specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, Believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. Also, unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find the company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."